Hey guys, welcome back to the KJ Methods YouTube channel. Today we are on the final financing test, part 5. If you've been following along, you know that we've done probably over 250 questions so far on various topics, so make sure you go back and take a look at those. For you guys who are new, my name is KJ. I run a program called the KJ Method. I'm an attorney as well as a pre-licensed instructor, and I'm here to help you guys pass your real estate exam. So don't forget to like, share, and subscribe, as well as if you want my free study guide, make sure to click the link below. All right, without further ado, let's get started on financing test part 5. Question number 41. A borrower is seeking to obtain a loan to purchase a property. The borrower has limited credit and only a small down payment. It is most likely that the borrower will receive A, an FHA guaranteed loan from the government, B, an FHA insured loan from a local bank, C, a conventional loan with PMI attached to it, and D, a VA guaranteed loan from the government. So what say you? It's a borrower. It doesn't say he's a veteran. It says he's a regular borrower, limited credit, low down payment. And so he's going to most likely get an FHA loan that is insured, right? And they're going to get it from a local bank. Remember, FHA does not loan money. They just insure these loans. You go into a local bank and get it. A is wrong because it's not guaranteed. D, there is nothing here indicating that this person is a veteran. And then C, a conventional loan. No, definitely not a conventional loan. Doesn't have enough money and has limited credit. 42. The process by which a borrower regains his interest in a property is called. This is KJ's low-hanging fruit. You should be able to answer this and move on because it should have already popped in your mind. A, is it called latches? B, foreclosure? C, redemption? Or D, deficiency judgment? Well, that is clearly redemption. If you remember, we have an equitable right of redemption, a statutory right of redemption. You're going to check your state law as to which one you have. But regaining property, regaining, that is your key, your context clue, regain redemption. 43, a borrower is seeking a loan for a house with a sales price of $550,000. After going to the bank, the process proceeds in what order? In what order? All right. So they're going to do a pre-approval, A, a loan estimate, appraisal, financing, closing. B, they're going to do a pre-approval, loan estimate, financing approval, appraisal, closing. C, they're going to do a loan estimate, pre-approval, appraisal, financing, approval, closing. Or D, a loan estimate, appraisal, pre-approval, financing, closing. Well, I think we all know that closing is going to be last, so that doesn't give us any clue. But they're going to do the pre-approval and then a loan estimate, appraisal, financing, approval, and closing. Now, this could be a little different, right? Because some banks, you'll go in and they're very fast with their pre-approvals. They know that they're going to be able to do a pre-approval. They're going to do a loan estimate. Sometime it goes in different order, right? It'll have the loan estimate within 3 days of you going in, and then the pre-approval. It really just depends on how fast this bank is, but please understand whether it is A or whether it is C, they always go to appraisal next, then financing, then closing, all right? There are some banks that pre-approve like that, and so that's why I have A here, but it could also be C, because if they're a little slower to pre-approve, then they're going to do that loan estimate, because don't forget, the loan estimate is required within 3 days of application. 44. You're representing a buyer who is purchasing and financing 19 acres of undeveloped land. He plans to subdivide the land into smaller building lots, selling them one at a time after financing and constructing new builds on each parcel. So understand, 19 acres, he wants to build a house, sell it. He wants to build a house, sell it. What clause would that buyer ask the bank to include in the mortgage? All right. A, a subordination clause. B, a due on sale clause. C, an exculpatory clause. or D, a habendum clause? Okay. The answer is going to be A here, subordination clause. So we're going to take a little time to explain it because you do see subordination clauses. Anytime you see that there is second money being brought into the transaction over the first money that's already there. So look, he already purchased and financed 19 acres. Then he wants to finance each house. So who's going to pay for the financing? Second money, right? You got the first money there, then new money is going to be coming in. And so what is he going to require in that first money? He's going to say, listen, I want you to subordinate, switch places with the people giving the new money. Why does he want him to do that? Because anytime a bank, or very often when they come with second money, they're like, I know we second, but I want to be first. I want them to go under me, right? So that I'm more protected, okay, than the land. So he had the land first, and now that first construction on that house, he wants them, that person, that bank wants to be first, okay? So subordinate means I want you to go under me. How do you pick it out on a test question? Anytime there's money already in place and another bank is bringing money after. Just say that second bank is late to the party, but they still want to be first, okay? So pretty simple to pick it up that way. 45, which of the following is true about prepayment penalties on VA or FHA loans for single-family dwelling? A, the VA requires a prepayment penalty of 2% of the outstanding balance. B, FHA requires a prepayment penalty of 2% of the original principal amount. C, both the VA and the FHA require prepayment penalties of 3% of the outstanding loan balance. And then D, neither the VA nor the FHA allows prepayment penalties. What say you? This is something that you just should know. We do not have prepayment penalties in FHA or VA loans. We want those people to be able to refinance those loans out, maybe get a lower interest rate, maybe move into a conventional loan. Because don't forget, FHA at the beginning wasn't the best loan, right? You had, I worked on my credit. Now I got better credit. I want to go into a conventional loan. We don't want to discourage those people from refinancing. So we say there's no prepayment penalties. If you pay it off, no problem. You can go ahead about your business and do whatever you want to do next. 46. Which of the following trigger terms would require full disclosure under TILA? If you remember, TILA has what we call Regulation Z, and they have these certain trigger terms that if you advertise any of these terms, then all of TILA comes crashing down. So if the bank advertises any of these, right, then the full TILA disclosure is going to be required, everything that TILA requires. Okay, so what can they do? What can they not do? Well, the real thing is that they can't say anything specific. So if you look at this, the answer is C, $900. Why? Because it's a specific monthly payment. They can say low monthly payment, high monthly payment, right? Low down payment, high interest rate, low interest rate. But as soon as they say 5% interest rate, oh no, then you got to tell me everything that TILA requires. So in this one, they're saying $900 monthly pay. Okay, tell me how you got to that $900. I need to know everything. But low down payment, totally fine. 47. Which of the following factors tends to increase the price of residential real estate in a given area? When are the prices going to go up? A zoning change allows a group home to be constructed in the subdivision. B, a large manufacturing plant is going to be opening in the city. C, higher interest rates on home loans. And D, an overabundance of homes in a preferred area. I'm going to take a little time on this one because a lot of times you guys have difficulty with when prices increase, decrease, and so forth. So the answer here is going to be B, a large manufacturing plant. How do I know that? Because A, a zoning change to a group home. Nobody wants to live near a group home. That's going to drive property prices down. Let's go to C, high interest rates. We learned this already. Once those interest rates keep going up, what's going to happen with the home prices? They got to go down because people are going to say, I can't afford that same price home at that interest rate, at that new interest rate. So that's not going to be it. How about D? An overabundance of homes in a preferred area. Let's think about it. There is a place, a subdivision. There are 25 homes for sale in that subdivision. So what's going to start happening? The prices are going to go down. So in this question, we're looking for what's going to make the prices go up. They're going to put a large manufacturing plant opening up in the city. What's going to happen then? They're going to bring in a ton of people. And what are those people going to need? They're going to need housing, right? So now you got all that competition for the housing. So what's going to happen to the prices? I wanted that house. You wanted that house. I wanted that house. The prices are going to go up, okay? 48. Which of the following are typical of FHA loans? A, they are insured and incorporate a balloon payment. B, they are insured and fully amortized. D, they are insured and partially amortized. D, none of these. You should know this off the top of your head. These are insured loans that are fully amortized. So the answer is B there. What does it mean fully amortized? They're insured by the government and they're going to amortize their way all the way out. Typically 30 years, meaning you're going to pay principal and interest throughout the entire time. And what does it mean when you get to the end? How much are you going to owe? Zero. That is what a fully amortized loan is. 49. When a mortgagor, think to yourself, who's the mortgagor? Borrower. You could use the term borrower. When the borrower buys a discount point, what effect does a loan discount point have for him? From him buying it. Why is he buying it? A, it increases the monthly payment to the borrower. B, it increases the cost of the loan on the secondary market. C, it decreases the interest rate. And D, it decreases the closing cost. So what do you think on this one? Mortgagor, what effect does it have for him? It decreases the interest rate. That is the reason why they're buying the discount point. They're saying, gosh, bank, I don't like that you're giving me 7%. Can I buy that rate down? Can I buy that rate down? And when I buy that rate down, don't forget the rate is going down. That means the monthly payments are going to be going down. And points, don't forget you only pay it one time at closing. 50, when a borrower defaults on a mortgage, an acceleration clause allows the lender the option of what? A, attaching the borrower's personal property. B, demanding immediate payment of the entire loan balance. C, reporting the borrower to both FHA and VA. D, preventing conveyance of the mortgaged property. Well, an acceleration clause does one thing and it's there for one reason only. If you don't pay that monthly payment, they're going to come after you for the entire loan balance. They're not trying to play with you like every month you late and they only could go for 1 month at a time. No, they put these acceleration clauses in there to say, I can come after you for the entire thing. So there's a clause that protects the bank. Well, that is it. Number 50. All right. We have totally covered all of finance in 50 questions. So I'm KJ from the KJ Method. Don't forget to like, share, and subscribe. And once again, click the link below if you want me to send you that study plan. After this, we are going to be working on value. That is the other topic that students seem to have difficulty with. Okay, guys, I will see you next time.